Today, we're going to talk about a corporate strategy that, on the surface, sounds like the exact opposite of success: breaking up. I mean, what if splitting a giant company into smaller pieces could actually make it more valuable? Well, that's the whole idea behind a corporate spinoff, and we're about to dive into how it all works. In the wild world of corporate finance, this is the kind of math they love to do. It's the big question. Can you take one massive company, break it into two, and somehow end up with a combined value that's actually greater than the original? A spinoff is basically a huge bet that the answer to that question is a resounding yes. And you know what? Sometimes that bet really pays off big time. Just look at eBay and PayPal. When they went their separate ways back in 2015, it was a game changer. Suddenly, eBay could double down on its marketplace, and PayPal was free to just innovate like crazy in digital payments. Both of them got leaner, more focused, and yeah, way more valuable apart than they ever were together. And this right here gets to the very heart of why a company would do this. See, Wall Street has this term for it, the conglomerate discount. It's this idea that when a company gets too big and complicated, investors kind of get confused. They can't see the value of each individual part, so they just value the whole thing for less than it's worth. A spinoff is a direct attack on that problem. Okay, so what is actually happening under the hood during one of these big corporate splits? Let's get into the nuts and bolts of it. So at its core, a spinoff is when a parent company takes one of its divisions, draws a line around it, and says, "You're a new independent company now." But here's the really cool part. Instead of selling off that new company, it just gives the shares away to its current shareholders. No money changes hands. You, as an investor, literally just wake up one morning owning stock in two companies instead of one. The process itself is actually pretty simple, at least on paper. First, the parent company picks a division that it thinks could do better on its own. Second, it creates a whole new legal company for that division. Everyone calls it SpinCo, complete with its own leaders, its own money, the whole shebang. And finally, it hands out shares of this new SpinCo to all its investors. Just like that, your one stock holding becomes two. But why go through all this hassle? I mean, it's a huge undertaking. Well, it's all about trying to unlock value that's trapped, just stuck inside a big, clunky corporate structure. It usually boils down to a few really important goals. You can really group the reasons into four main buckets. First, value creation. A simple, focused company is just plain easier for investors to understand and value correctly. Then there's operational focus. Management at both new companies can pour all their energy into what they do best. A huge one is the financial benefit. These deals are very often tax-free, which is a massive incentive. And finally, it's a great tool for risk management, letting a company wall off a risky new venture from its stable core business. Okay, that's the view from the boardroom, but let's bring it down to what really matters for us. What does a spinoff actually mean for you as an individual investor? How is this going to hit your portfolio? It's actually pretty straightforward. Before the split, you own one stock. After the split, you own two. Now, this is super important. The parent company's stock price is going to drop on the day of the spinoff. Don't panic. That is not a loss. All that's happened is that a piece of the company's value has been neatly lifted out and handed to you in the form of those new SpinCo shares. One thing you should definitely expect is some choppiness in the new stock's price right after it starts trading. And this usually isn't because there's something wrong with the company. It's more of a technical thing. Big index funds or other institutions might have rules that say they can't own this new, smaller company, so they're forced to sell their shares. All that selling pressure can push the price down for a bit, which for some investors can look like a buying opportunity. So now you have a decision to make. What do you do? Well, you've got options. You can just hang on to both stocks, simple as that. You could sell the new shares if that business just doesn't fit your investment style. Or, hey, if you really believe in this new, focused company, you might even decide to buy more. The bottom line is, you've got some homework to do on this new kid on the block. But here's the reality check. Is a spinoff a guaranteed home run? Absolutely not. A big study from the Harvard Business Review looked at a ton of these and found the results are, well, basically a coin flip. About half the time, they created value, but a quarter of the time they created no new value at all, and another quarter actually lost value. It just goes to show you, the idea of a spinoff is great, but the execution is everything. And just when you thought you had it all figured out, it's important to know that the classic spinoff we've been talking about is just one way for a company to separate. There are actually a couple of other important flavors of this. So let's quickly break down the big three. The spinoff is what we've been focused on. The shares just show up in your account automatically. A split-off is different. It's an offer. The company says, hey, does anyone want to trade in their parent company's stock for shares in the new business? It's your choice. And finally, a carve-out is something else entirely. It's basically a mini IPO, where the parent sells a chunk of the new company to the public to raise cash, but it usually keeps control. Okay, so let's zoom out. After looking at the what, the why, and the how, what's the real big picture takeaway here when it comes to corporate spin-offs? At the end of the day, a spin-off isn't some kind of magic bullet that instantly fixes everything. Think of it more like a precision tool. When it's used with a really clear strategy and great execution, it can be amazing, unlocking a ton of value and creating two stronger companies. But without that clear vision, it can fizzle out and fail to deliver on all that promise. And that really leaves us with a fascinating question to chew on. For decades, the corporate mantra was always get bigger, merge, acquire, grow, grow, grow. But as we see more and more giants, think GE, eBay, Johnson & Johnson, choosing to break themselves up, you have to wonder, in this age of mega corporations, is splitting up actually the new, smarter way to grow?